Well, let's dive deeper into markets. Higher oil prices holding back the major averages today as the war in Iran continues to fuel uncertainty among investors. Our next guest says we should continue to expect violent, at times, rotations because of what she calls short attention span money. In part, joining us now is Schwab Center for Financial Services Chief Investment Strategist Sonders. Lizanne, welcome. Always good to see you.
Hi, Mike. You too. Thanks for having me.
Of course. These rotations that we keep talking about, right? You have this unusually kind of sideways S&P 500, lots of dramatic moves underneath. Are there messages that you're drawing from that activity that we should really keep in mind right now?
Well, let's just put some numbers on it, Mike. You've had limited drawdowns at the index level. Maximum drawdown for the S&P is only 3% at the index level. It's on a year-to-date basis. It's only 6% for the NASDAQ. But under the surface, there has been more violence. So the average member has had a max drawdown in the S&P of 14%. And for the NASDAQ, it's negative 27%. So you've had these kind of micro-level bear markets that have just happened via this process of rotation. Some of it is obviously how quickly the data changes, narratives can change, also positioning. There's a lot of short-term money that is looking for both opportunity and where things get stretched, both on the long side and the short side. And that's why these moves can happen so swiftly, especially if there is some sort of news item that triggers a narrative change. And it's hard to see an environment where we get out of that kind of pattern for the market.
And I guess in one sense, the way to describe what you're saying is it is a market struggling for the next narrative thrust. And I wonder if this idea of at least directionally stagflationary inputs are holding the markets in check. Has what's gone on this year really altered the assumptions about how the economy was going to be? Because it was all about, run it hot. The consumer should have tailwinds. Financials were leading. They no longer are. So it's become a little bit of a scramble.
It is, and I think the inflation story is an incredibly important one. I don't think we're looking necessarily at a setup akin to the 1970s and that era's version of stagflation, which the economic side of that term back then referenced a pretty rapidly rising unemployment rate, which we don't have at this point. So now we think of stagflation as more of a generic, a slowdown in growth and a pickup of inflation. But it does put the Fed in a pickle, and that's why you're seeing rate cut expectations get pushed further out into the year. And even before the eruption of the war in Iran, what you had been seeing is a much more diversity in terms of perspective on the part of the members of the FOMC. More frequent dissents, greater dispersion in terms of things like the dots plot and summary of economic projections, just a wider array of views being expressed when Fed speakers are out there. That's a good thing from the perspective of concerns about threats to Fed independence, but it is reflective of this very unique period of time where inflation volatility and the Fed's reaction function is much more in sharper focus than it's been in years past.
In terms of the short attention span money, Lizanne, I'm just curious if that's what you're seeing on the Charles Schwab platform among retail investors. I know that's not necessarily your bailiwick, but do you get the sense that investors are afraid that they're going to miss that rip higher? Because if there's short-term money seizing the opportunity, there might be this fear they're going to miss out on this rip-roaring rally if something gets resolved, and that could come any day now.
So here's the distinction that I would make. I try as much as possible to remind people that there is a distinction between, say, retail traders, that cohort born out of the pandemic. They skew younger, they skew male. They gave rise to the meme stock craze and things like, the betting markets. That's kind of the short attention span money. But the likes of the Citadels that tracks this kind of flow data on a more regular basis than we do at Schwab suggests that money can represent at least 25% of trading volume on a daily basis, if not more on some of the more volatile days. And then you bring in some of the shorter term speculators in the institutional world and the CTAs. And that's the cohort I'm talking about. We find that our longer term individual investors do understand the benefit in this environment of relying on those more tried and true disciplines like diversification across and within asset classes. And that is certainly an easier sell to, if anything, lengthen time horizon, rely on those traditional disciplines, including more frequent rebalancing, perhaps that's portfolio driven. So I think it will continue to be that differentiation between the individual investor that takes a longer term approach and that shorter term trader that has a little bit more of a gambling mentality.